Hello everyone, welcome back to the channel. In this video, we will discuss one of the most important topics in international taxations, the tax treaty between Indonesia and China. This topic is highly relevant because trade and investment relations between Indonesia and China continue to grow rapidly. Many companies engage in cross-border transactions such as dividend payments, royalties, technical services, construction projects, and digital business activities. However, the question is, how do we prevent the same income from being taxed twice in two different countries? This is where the role of a tax treaty becomes crucial. The Indonesia-China Tax Treaty or Double Tax Avoidance Agreement aims to avoid double taxation and at the same time also to prevent tax evasion related to cross-border income. Legally, this tax treaty is a bilateral agreement between the government of Indonesia and the government of the People's Republic of China with the following objectives: avoiding double taxation, providing legal certainty in taxation, preventing tax avoidance in cross-border transactions. In Indonesia, the implementation of tax treaties is governed by several key legal bases, including the income tax law, the Indonesia-China Double Tax Avoidance Agreement, Per 25 PG 2018 on procedures for implementing the Double Tax Avoidance Agreement, Per 28 PG 2018 on certificates of domicile and administrative provisions regarding the use of the digital form when applying for treaty benefits. These regulations form the basis for taxpayers to obtain reduced tax rates facilities on transactions such as dividends, interest, royalties, and other cross-border business transactions. As trade and investment between Indonesia and China continue to grow, understanding the tax treaty becomes increasingly important, especially for companies engaged in international transactions. So specifically, what is a tax treaty and how does its implementation mechanism work? How are tax rates regulated under the Indonesia-China Tax Treaty? What is a permanent establishment? How does beneficial ownership work? How does exchange of information work? What are the benefits and risks in cross-border transactions? These are the topics we will cover in this video. First, what is a tax treaty? First of all, we need to understand what a tax treaty is. A tax treaty is an agreement between two countries that determines which country has the right to tax a specific type of income. Without a tax treaty, a single income could be taxed twice. First, in the source country of the income, and second, in the country of the residence of the taxpayers. For example, if a China company receives royalties from Indonesia, both Indonesia and China could impose tax on that income. A tax treaty addresses this issue by allocating taxing rights and providing lower tax rates. 2. Tax rates under the Indonesia-China Tax Treaty. One of the main benefits of a tax treaty is the reductions of withholding tax rates. Under Indonesia's domestic regulations, payment to foreign taxpayers or non-residents are generally subject to a 10% tax rate. However, under the tax treaty, that rate may be reduced. The applicable rates are as follows: dividends 10%, interest 10%, royalties including software usage, trademarks, technology, and other intellectual property rights taxed at 10%. Additionally, for a permanent establishment or PE and base profit tax, a rate of 10% may also apply. However, it is important to note that these treaty benefits do not apply automatically. Taxpayers must fulfill administrative requirements such as holding a certificate of domicile, using the digital form, and meeting the beneficial ownership's requirements. If these conditions are not met, Indonesia's domestic tax rate of 20% may still apply. 3. Permanent establishments or PE. One of the most important concepts in the Indonesian-China Tax Treaty is the permanent establishment or PE, commonly referred to as BUT, bentuk usaha tetap in Indonesia. A PE is essentially a fixed place of business used by a foreign company to conduct business activities in another country. Examples include branch offices, factories, workshops, construction projects, and certain services under specific conditions. Why does PE matter? Because if a China company is deemed to have a PE in Indonesia, then Indonesia has the right to impose tax on the business profits arising from those activities. For example, if a China construction company works on a project in Indonesia that exceeds a certain time threshold as defined in a tax treaty, that project may be considered a PE. This means the company may have obligations to register for a tax identification number, file tax returns, and pay taxes in Indonesia. Therefore, PE risk analysis is critically important for foreign companies operating in Indonesia. 4. The concept of beneficial ownership. Now, we move to a very important anti-tax avoidance concept, beneficial ownership. Taxpayers do not automatically qualify for treaty benefits simply because they are based in China. The tax authority will also assess whether the income recipient is truly the party that economically benefits from the income. In other words, the recipient must genuinely have control and benefit from the income. For example, if a company acts merely as an intermediary or conduit company to pass income onto another party, the treaty benefit may be denied. Indonesia is quite strict in applying the concept of beneficial ownership to prevent treaty shopping. Therefore, cross-border business structures must have genuine economic substance. 5. Exchange of information. The Indonesia-China Tax Treaty also includes provisions on exchange of information for taxation purposes. This allows the tax authorities of both countries to share information for monitoring and tax enforcement purposes. In today's era of global tax transparency, tax authorities are increasingly able to detect hidden transactions, transfer pricing risks, and cross-border tax avoidance practices. This means taxpayers must ensure that documentation is complete, transfer pricing policies comply with the arm's length principle, and all cross-border transactions are properly reported. International tax compliance is now more important than ever. 6. Impact on business. So, what are the practical implications of this tax treaty for businesses? These are several key benefits. Reduced tax burden. Companies can enjoy lower withholding tax rates. Tax certainty. Companies can more easily predict their tax obligations when engaging in international transactions. Improve investment climate. The tax treaty helps attract foreign investment by reducing tax-related barriers. However, companies must also be cautious. Incorrect applications of a tax treaty can trigger tax disputes, tax audits, administrative penalties, or denial of treaty benefits. Therefore, companies involved in Indonesia-China transactions should conduct tax reviews and ensure they maintain adequate documentation. In conclusion, the Indonesia-China Tax Treaty plays a significant role in supporting trade and investment between the two countries. The agreement helps to avoid double taxation, lower tax rates, provide legal certainty, and enhance cooperation between both countries. However, taxpayers must also have a thorough understanding of the rules and regulations, particularly regarding certificates of domicile, permanent establishment, beneficial ownership, and other administrative requirements of the tax treaty. Since international tax regulations continue to evolve, companies need to stay updated and proactive in maintaining their tax compliance. Thank you for watching. Don't forget to like, comment, and subscribe for more educational content on taxation and international business. See you in the next video.